Hello and welcome. Here's a business where there's a bit of a turnaround which may have been visible very minorly in Q1. The hope is that H2 will be a very strong half in that sense of FY26, and thereafter you'll start to see likely FY27 be a year where there's some bit of normalization which will kick through. There is scope for that. Margins have fallen quite sharply. We're talking about a Century Ply, and let's try and pull up what I want to know first off. Try and understand that better. There has been overcapacity, and apologies, Puneet Javeri also joining me. Anyway, so there has been overcapacity. Pricing has been a concern, Puneet, but some of that is unwinding. We can see that. Second is there is also scope for positive momentum both on pricing as well as inventory. Both of those could likely improve things substantially, even with minor tweaks coming. Also, Q1, Puneet, has been decent even where volumes is concerned. So you're seeing some of those start to play out already. Some drags with regard to ad spends, and let's pull up that second metric. I'd want to know whether the real estate cycle is what you really want to look for when it comes to a Century Ply. But what they are really saying as part of their commentary in Q1, whatever I read of it, was that there has been a largest shift from unorganized to organized. That's what they're really targeting. They're saying real estate is not something we want to really benchmark ourselves to. What we want to benchmark ourselves to is this shift from unorganized to organized. So what I want to know within this, all of this, is does real estate not play a role at all? That's my first part of the question. Second is, as you shift from unorganized to organized, what is it that they are doing which is helping them stand out, if at all anything? Now, point number 3 is with regard to cash conversion cycle. We've seen cash flows be really muted in FY25. In fact, cash from operations was negative, minor negative, which doesn't look good on a 200 crore profit. And we look at those numbers as we look at the metrics. Does that turn positive going forward? Are we seeing that cash conversion cycle start to play out because they're doing heavy capex? Maybe part of that is also due to the heavy capex that they're doing, that they are keeping more raw material on their books as well as more finished product on their books. Maybe it's that, but some part of that has to turn positive. How fast can capacity utilization ramp up? We've seen capacity utilization of more than 90% on all their traditional or rather their legacy plants. So we're seeing very good capacity utilization there. But on the new plants, how quickly can they ramp it up? Because there's so much capex happening. Any more capex plans, and when will debt start easing? Debt has gone up substantially. We look at those numbers. Does that come off? Is there more capex in the pipeline? They've done 2,000 crore more in the pipeline or not? What's the outlook with regard to price hikes and margins, especially margins? And you look at the numbers, and that's what you will see as well, that margins is really what's pressuring the entire business and profitability. If that were to unwind, you could well see a bit of a turnaround coming in on the numbers. And last piece is on ad spends. They've spoken about Q1 FY26 being a tough quarter on the ad spends part of it, and largely due to IPL. But does that, from an FY26 perspective, is it a normalized kind of spend that we can expect, or will it be elevated even for FY26? That's the other piece I'd want to know. So that's all I want to know with regard to Century. It's a long one, but I'll allow Puneet to start off with about the company.
Well, definitely. It's one of India's leading, plywood as well as wood panel product manufacturers, the biggest to say the least. And it is one of the most pivotal ones because it is driving that share of organized space within the industry. Now, it's been, 38 years in the business. It is listed, of course, on both NSE and BSE, headquartered largely in Kolkata, but now has pan-India presence with manufacturing and sales distribution as well. Over the last, 38 years, they've built 4,000 dealers, 18,000 retailers, as well as now are targeting global exports as well, and are focused keenly on innovation, branding, as well as deep market research as well. Very quickly in products as well, because plywood continues to be the dominant share of the company. 56% of the sales come from there. We've also seen, it has key brands like Scenic in the mass market space, as well as Architect, amongst others. But Scenic is the real one. It has strong branding. Advertising has been the push over the last decade or so. and has really established itself in this particular space. Laminates is the other traditional legacy segment which Harsh was mentioning about. It's been the decorative overlay as well as, panels and furniture that they do. Now, it has been one of the legacy ones to say the least, but here is where it gets interesting. Because over the last few years, they've added MDF, which is medium density fiber board, and the other one is, of course, addition of particle board. Both these segments have been a key drag on the financial, and we'll speak to the management on that. From MDF, that's roughly 20% of the company's sales. Laminates is roughly about 17 to 18%, and particle board is currently low at 3 to 4%. But that's been one of the key drags over the last year or so. So that's a little bit about the business, and decorative veneers as well as other products are largely new ones. But these are the 4 traditional businesses of the company. But Harsh, on product mix as well as geography.
Yeah, you spoke a bit about the mix, and there you go. So that's the mix broadly. We are seeing nearly 60% of that coming from plywood, block board. You have MDF. Which is medium density fiberboard, which accounts for roughly 20% odd. There's laminates, which is also nearly 18%. 3 to 4% is pre-laminated plyboards, and then there's others. So that's really how the mix has evolved. Look at the geography. 95% of the sales are domestic, so it's largely domestic facing. Domestic consumption and interiors, once that cycle picks up, or if that segment were to grow, this is a great play on that. Exports is very, very small at this point, even though margins are better there. When you're looking at capacity utilization, and that will give you a clearer picture of my question as well with regard to capacity utilization. Apologies, let's first look at the manufacturing locations actually. First, you have 14 Indian, 3 overseas locations, including Gabon and Laos. The Laos unit has actually been divested, so has Gabon, but nonetheless you still have those overseas units as well. Major sites are West Bengal, Punjab, Assam. West Bengal understandably, and northeast presence clearly visible, but outside of that you have Gujarat, Tamil Nadu, AP, Haryana and Uttarakhand. All of those are the significant manufacturing facilities which are there. They sell to dealers, distributors, retailers. That's largely in the domestic market, that 95% plus share, which is the domestic share in terms of the top line. And when you're looking at capacity utilization, you'll see 91% in terms of the plywood capacity utilization, so extremely strong. Laminates at 90. MDF is at around 65 to 70, but after major expansion, it's come down to that level. Otherwise, it used to be 90 plus. And the particle board segment is also, or used to also be, above 90% prior to the new plant which has been commissioned. So that's how we've seen how the company has evolved, and what they are up to right now is that large capex they are doing, due to which capacity utilization has compressed, and therefore you'll see some compression across the board with regard to numbers, especially on the return ratios, because that's the return on capital employed will come off because of that. That's how one ought to look at it. Now let's look at the metrics as well. We'll start off with the income statement, the balance sheet, the cash flow, the return ratios, the shareholding, the street cred, the street coverage, and valuations. We look at all 8 of them, and I'll allow Puneet to start off with the income statement.
Well, largely it's been a decent performance in terms of revenue, Harsh, and that's grown at 14% CAGR, roughly in FY22, roughly about 3,000 crores in terms of revenue. The revenue from MDF as well as particle board has helped the consistent performance in terms of revenue CAGR. But when you look at the EBITDA performance, and here is where it gets, there's some disappointment that starts to set in, because both the new segments of MDF as well as particle board have had an impact both in terms of margins as well as in cash flow, which we'll discuss in just a bit. So actually the CAGR of EBITDA is actually down 532 crores what they did in FY22. It's down to 487. Subsequently, margins have gone down by 700 basis points over the last 3 to 4 years to 11% now, and profit subsequently has dropped from roughly about 313 crore to about 186 crore. Margin trajectory has been downward. That's largely led by the higher timber prices, which is impacted as a key raw material. But hence we've given this, in terms of margin trajectory and neutral, but that's largely been a drag on margins because of the new segments that the company has entered.
Yeah, the double-digit top-line growth is still okay, Puneet. It's really that margin number which is dragging the overall profitability. It's also the increase in interest cost because of the large capex they've done, funded via debt, and the larger depreciation as well that's come through. Maybe not the most relevant metric when you look at a company which has grown to look at depreciation, but nonetheless, that's the other impact which has come through on the net profit number, and that's why it's looking lower. If I look at the same net profit in FY24, the number is around 325 crores. So that's just how large it was, and the compression has been extremely large from 325 to 186. So we've given this a neutral, also on the back of the fact that there's possibility of turning this around. The top line growth remaining as is, if margins were to improve, if raw material prices were to compress, gross margins improving, therefore EBITDA margin improving, you could well see some increase, some disproportionate increase in profitability. And that's why you want to wait and watch for that one where income statement is concerned. Let's look at the balance sheet now. And when you're looking at that, the book value is at around 2,400 odd crore at the end of FY25. Mind you, this has a market cap of 16,000 crore. So the price to book is obviously looking quite expensive. But when you look at the borrowing number as well, you look at the borrowing number of nearly 1,500 crore, and you look at it 2 years ago at just 300 crore. That's because of the large capacity increase that they've undertaken, the largest in their history. And due to that, what you are seeing is a very large increase in the borrowing number. Now, when I'm looking at the interest coverage ratio, which is the interest expense to the EBITDA number, it's roughly 5 times. So they've got themselves covered quite well. But the ballooning debt doesn't look good, so that's something you want to watch out for. And how quickly can they bring it off? They've guided that they'll bring it off fairly quickly. So again, we'll talk about that with the management, and you'll get a better sense of that. Cash flow, Puneet.
Well, cash flow, has been impacted, as I mentioned, in terms of similar performance to the company's, CAGR, as we mentioned, in terms of margin trajectory downward. Cash flow, because of that, has been impacted. So net cash flow just hardly a negative 3 crore in this particular quarter. In FY25, they didn't. In FY24, pardon me, they didn't maintain 27 crore of decent net cash flow. But that's largely impacted in this particular quarter. Even the cash flow from operations have been impacted because of the 2 new segments, and we'll speak to the management on the trajectory of that. But cash flow largely a thumbs down because of this aspect.
Well, yes, to be improved. Return ratios, and this is also more of the same. When you look at the return ratios, they come off sharply, but earlier it has the potential of doing 20% business, that 20% ROC. That's what I would really look at if I were an investor, that the potential is there. Now, whether you can bounce back from 10 towards 18, 20 and above is really the question that one as an investor needs to ask themselves. So we've given this a neutral from a perspective that the potential of the business has, or the business has the potential to do 20-30% ROC, which is extremely good. But of course, due to the cycle as well as due to certain factors, that has compressed in FY25. Can it reverse is really the question. So we've given this a neutral. Shareholding pattern, Puneet.
Largely stable, and this is a credit to the management. They've maintained over 72 to 73% stake in the company. That's a very strong number. We've also seen an increase from domestic investors at a time, in a tougher time to say the least. So most look like they are anticipating any kind of turnaround, but foreign investors have actually reduced stake over the last 3 years, while domestic investors have increased stake. The share of public remains largely even at 5%, but even compared to the last couple of years, that has come down substantially from over 9%. So while we've given this a thumbs up on promoter stake, we have seen retail investors largely come in fairly quickly, and we've also seen that from domestic institutional investors like mutual funds as well. So largely, it does anticipate we might be at the bottom of the cycle and a reversal soon. That's what the shareholding pattern indicates, but largely a thumbs up on strong promoter parentage.
Well, that's interesting observations from Puneet, but let's pick up what the street cred is. You look at the last 6 months, the stock is absolutely flat. If I remove the performance of today, in fact, year to date, the stock is actually down 5%, down 10% if I factor in today's move. You're looking at the 1-year performance also largely being flattish except today's move, and the 5 years though has looked very, very good. It's been a 5.5 bagger over the last 5 years, near 5.5 bagger. So therefore, we've given this a neutral. Long-term prospects decent, short-term not looking as good, and therefore that's how we stacked it up. Street coverage, Puneet.
Largely, fairly certain because most brokerages have maintained their view. We're seeing a lot of hold calls on the company, roughly about 8 are hold calls. There is an error in the graphic. It should be 12 buy calls and 8 hold calls for the company in this particular time frame. And brokerages like Nuvama have actually increased their target price in this particular quarter, signaling that this could be the bottom of the cycle and a reversal could be upwards. We're also seeing a decent return potential going forward as well. But largely, given this, a thumbs up to a neutral rating, a positive rating to say the least, and that's largely because of most brokerages anticipating a reversal from the lows.
Yeah, most brokerages anticipating a reversal is surely good. Therefore, let's look at valuations and how those stack up. You're looking at 1 year forward valuations of around 50 times. If one were to pencil in a growth of around 15% and margins of around 12%, you'd land up at around 59 times earnings 1 year forward, which is FY26. That's of course the brokerage estimate of all the brokers put together. That's 50 times. When you look at some of the others, they are obviously looking slightly more expensive in comparison to a Century. And that's one reason why, but nonetheless, does that mean it's not looking expensive from a stock perspective? It is. It's trading at nearly 90 times trailing 12 months, of course, on a year in which the base has been readjusted completely. But nonetheless, it's surely looking more expensive in relative terms. We'll have to obviously look at the next 2 to 3 year view, and for exactly that we'll speak with the management in just 1 minute. But let's really stack up all the parameters and give it to you in one slide. There you go. Those are the first 4, those are the next 4, and that gives you 3.5 on 8 with regard to the KYC rating. Of course, this is everything included. And a lot of these are also factors at play in the market. So what I want to really understand is whether that things are really turning around or not. Keshav Bhajanka, who's the Executive Director, Century Plyboards, joining us at this time. Thank you so much, Mr. Bhajanka, for joining us. Let me first start off by understanding what the outlook is going forward and what's the confidence with regard to outlook, sir. What's the kind of top line growth, FY26, mid-teens, can we expect that for the next 2-3 years? And how do margins move in your opinion?
Good morning.
Good morning.
Thank you so much for having me on the show. I think that, we have reasonable confidence that the current year is going to be a strong year. Our guidance given is 10% for growth for plywood, 20% for laminates, 20% for MDF, and 40% for particle board based on the new capacity that we have added. And I think we are pretty much on line to meet or perhaps even exceed these guidances. Weighted average, that would give you a mid-teen sort of a growth for the year. And going forward, I think we have done reasonably well considering a difficult market scenario in the current year. So going forward, we may be able to accelerate on this growth slightly. But I think that next few years, the wood panel sector in general is going to do very well. And being market leaders, I think our aim will be to gain market share.
Mr. Bhajanka, very good morning to you. It's Puneet this side. Thanks so much for joining in today. It's been a while since we've spoken to you, sir. So just a couple of key points. We've seen since then the BIS implementation has come in and that is expected to benefit the organized space. What do you expect in terms of volume versus value growth for this year? Because you've given a decent guidance across the key segments. So what is the expectation on this aspect?
I think we generally tend to give value guidance. The volume guidance is usually slightly lower because there is an inflationary environment currently. In plywood, we've already taken a price increase. In laminate, we've taken a price increase. So I think single-digit volume growth in the case of plywood, and of course 20% or slightly lesser in the case of MDF is what we are provisioning for. Overall, I would say that the demand, the buoyancy in demand currently isn't very visible, but there are signs, there are green shoots that things have started to ease out, particularly after the rate cuts by the RBI, even though that hasn't passed on to home buyers yet. And I think there will be some easing out.
Sorry, sir, does the GST change likely, does it impact you at all?
I don't think that there is any major change that is coming up in GST for the plywood sector. I think, maybe sectors like cement or others where they're talking about a 28 to 18 will get benefited. But I'm not aware of any substantial change that is likely to take place in the wood panel sector. I missed the earlier question, sorry, with regards to the BIS implementation. The BIS implementation will definitely help us in a big way. The only thing is that it is effective only from this month, because small and medium enterprises were given a 6-month sort of a breathing space where they were exempt from enforcing BIS from August. So they needed to ensure compliance with BIS from August. So from this month onwards, we should see a substantial benefit from the BIS implementation, and this should definitely aid the organized players.
Vajanka, you mentioned that you've taken some price increase in plywood as well as laminates. Those are two segments that have done very well for you. The competition in MDF, rather not competition in terms of oversupply that we've seen. How do you look to counter that in FY26? Because that's largely been in oversupply. You can't take any kind of price hikes in a segment that's been slightly struggling over the last year or so because of market condition amongst others. And your growth guidance also is, in terms of Q1 also at roughly about 19%, and I think most brokerages were penciling in 28 to 30% volume growth. So compared to last year, your growth outlook for this year is also slightly below estimates according to brokerages. What do you expect of MDF for this year, and do you expect that it will be slightly tougher for this segment and a larger, flatter performance is what should be expected?
I think, you summed it up very well, that in MDF, because of the oversupply, it is difficult to take price increases. But at this point in time, what we have been focusing on is an optimization. With the new plant coming up in South, last year we saw a huge jump in our volumes. Of course, that is because of a new capacity coming in. This is something that we will not be able to replicate year on year, but 20% plus growth, I'm fairly confident of in MDF. Because price increases seem to be limited due to oversupply, we are focused on operating efficiency, and I think that we have been able to save close to 4 to 5% just by optimizing, by looking at various ways to look at substitutions in raw materials, to look at ways in which we can optimize BOMs, our bill of materials, by optimizing consumptions, by redesigning our logistic network, where we supply from the Hoshiarpur plant and where we supply from the South Badvel plant. Through all of this, we have actually been able to substantially improve our bottom line. And in this environment where you can't take price increases, to maintain margins, you will have to become more efficient. So going forward, when the inflationary environment comes back, when we can take price increases, I think there could be a scope for a much higher EBITDA number.
And Mr. Vajanka, somewhere around last year, Q1 and Q2, the timber prices were hovering roughly about 6.5 to 7 rupees per kg in the northern belt, 5.5 to 6 rupees per kg in the southern belt. Is that still the pricing environment that you've seen in the market? Because we were expecting some kind of bottoming out of that aspect in this quarter, but largely seems to be absent. Could you give us some perspective on what has happened this quarter and for the year?
It has definitely slightly eased out. I wouldn't say that, there's been a substantial tapering down, but there has been a reduction in timber prices. However, the challenge here is that rainy season, which is typically this period, is always difficult for North India. In North, the availability of timber becomes difficult as far as Q2 is concerned. So prices look slightly elevated. Compared to last year, prices are lower. And in the next few months, we're expecting prices to further fall more. As far as South India is concerned, prices have tapered off, and we're expecting slightly further tapering off going forward.
In this environment, sir, you're expecting margins to hopefully creep up. I'm talking about company as a whole. How do you achieve that? Is it going to be some calibration on the raw material side? Is it scale? Is it logistics, which you spoke about? So that's the first part. The second part is, how do you stand out as well? You have insisted that you don't want to be linked to the real estate cycle. You want to be linked more on the shift from unorganized to organized. And therefore, how do you stand out within this space?
So the two big questions. But in terms of margins, the profile that we have given, we have said that in plywood, we'll aim to do 12 to 14%. In laminates, we'll aim to do double-digit margins. In MDF, we'll aim to do 15%. And in particle board, at steady state, we'll aim to do 15%. So that in itself will take our margin profile closer to the 15% mark. I think this is something which will play out over the course of the current year. In order to do this, we have definitely benefited a lot from strong numbers, from growth that most companies in our sector have not been able to benefit from. Last quarter, I think plywood grew at 15% plus, MDF grew at 20%, and so on and so forth. So these have aided. Alongside that, like I mentioned, operating efficiency in terms of both consumptions, raw materials, and logistics have definitely helped us out. And going forward, to differentiate yourself, we have always believed that customer first and quality, these are two things that you cannot compromise on. So there are a number of initiatives that we have done which have enabled us to reach out directly to customers, to understand their needs, their requirements, and to plug them faster. At the same time, the quality of our products, I think, is appreciated by the industry at large.
Right.
So this enables us to be a little different. This enables us to be more on the side of the organized play rather than just the real estate play. And the organized sector in us, in plywood in particular, is still just 30%.
Sure.
So there's a long way to go.
Right. Thank you so much, sir. We're completely out of time on this edition of the show. So thanks so much for joining us, giving our viewers that perspective. And viewers, from Puneet, myself, it's a thank you and a goodbye. And thanks for tuning in. Stay with us. More action on the other side on NDTV Profit.